Mr. Jide Sanwo-Olu, the Executive Governor of Niger State, Governor Abubakar Sani Bello, the President and Chairman of Council of the Chartered Institute of Bankers, Mr. Bayo Olugbemi, other very distinguished heads of agencies here, and I think it's fitting that I recognize the MD of Nigerian Deposit Insurance Corporation, the Director General of Securities and Exchange Commission, other very important dignitaries here present, Your Excellencies and our friends from our foreign community here in Nigeria, CEOs of banks, distinguished ladies and gentlemen. Today, being the last Friday of the month of November of every year, is a day that I always look forward to. I look forward to this day, not necessarily because of the keynote address I will be presenting, but also because it reminds me that after a very hard work in the course of the year, that we are about to wind down and kick off into the Yuletide. I wish all of us a Merry Christmas and happy and prosperous 2022. Again, I say good evening, distinguished ladies and gentlemen, and I thank you all for the very warm reception accorded us here today. By now, I am sure everyone knows how I feel about this annual dinner, because since I became the governor of the Central Bank of Nigeria over 7 years ago, this is perhaps the one event I have never missed at all. So, to underscore how important this event is to me, let me repeat and say and stress by saying that this is my 7th consecutive keynote address at the Chartered Institute of Bankers annual dinner as the governor of the CBN. It is therefore a great pleasure for me to be here today because it provides a veritable platform and a significant opportunity for me to engage with all stakeholders, especially professionals, practitioners, and experts in the banking and finance community. This dinner is an occasion to highlight important developments in our economy and apprise you of the policy initiatives and focus of the Central Bank of Nigeria towards realizing the ultimate goals of macroeconomic and financial stability in our country. I'd like to especially thank the leadership and fellows of the Chartered Institute of Bankers of Nigeria, led by the President, Mr. Bayo Olugbemi, and the Registrar, Mr. Sheyawo Jobi, for their painstaking efforts towards the success of today's event. I also want to extend my heartfelt gratitude to the Managing Director and Chief Executive Officers of banks and other financial institutions who have found time to attend this dinner despite their very busy schedules. Let me also welcome my colleagues from the Central Bank of Nigeria, particularly our deputy governors, our directors, and some senior management members of staff of the bank. And I also like to thank the audience and members of the press for being part of this very beautiful occasion today. Distinguished ladies and gentlemen, in my remarks today, I intend to provide my views on developments in the Nigerian economy, as well as an outlook for how we see things going forward. as will be expected from an incisive analysis of any major economy in the world today, let me begin with an initial background of the Nigerian economy before COVID-19. Prior to the start of the pandemic in 2019, our economy was making steady progress out of the difficulties from the global oil price vagaries of the previous year. Indeed, our GDP growth rate for 2019 stood at 2.3% on the back of a relatively strong fourth quarter GDP of 2.55% that year. This growth was accompanied by significant foreign capital flows due to improved fundamentals of our economy. Distinguished ladies and gentlemen, then came knocking the pandemic during the first quarter of 2020, and indeed, it's been close to 2 years since the onset of the COVID-19 pandemic and the wide-ranging impact it has had on not only global economy, but also the Nigerian economy. We must all remember that while its economic damages have been enormous and will be highlighted soon, this pandemic is first and foremost a public health crisis instigated by a virus that has infected 259.7 million people and claimed the lives of 5.2 million people globally, including 2,974 of our fellow Nigerians and loved ones. Indeed, let me state that in May 2020, it would have been unlikely to hold an event of this nature with the number of people we have here today. Our ability to come together today is a reflection of the progress that has been made in containing the spread of this virus, as well as in supporting improved economic activity over the past 2 years. In my remarks today, I intend to provide my perspectives on the external and domestic impact of the pandemic and its attendant effect on the Nigerian economy. I'll also provide an outlook for the Nigerian economy as well as steps that the CBN is taking to support improved economic activity in Nigeria. On the global economy, as you may recall, 2020 was a year like no other for the global economy and indeed the Nigerian economy. The onset of the COVID-19 pandemic in the early part of 2020 and the containment measures put in place to slow the spread of the virus led to an unprecedented decline in global growth, last seen since the Great Depression of the 1930s. Most advanced and developing economies fell into a recession, which led to a significant contraction in global growth by minus 3.1% in 2020. Global travels was also restricted as countries shut down their borders and restricted domestic and international travels. According to the latest Economic Impact Report by World Trade and Tourism Council, the global travels and tourism sector lost about $4.5 trillion from the effects of the travel restriction, quarantines, and other related measures. Also, according to the International Labour Organization, in 2020, over 255 million full-time jobs were lost as a result of the pandemic. Some of the major events during the pandemic. During that period, we saw a volatile oil market. First, in view of the complete stoppage of global economic activities, we witnessed the significant reduction in the demand for and price of crude oil, Nigeria's main source of foreign exchange receipts and fiscal revenue. Indeed, the price of crude oil fell by more than 70% at some point, we witnessed a fall in crude oil prices from a high of $68 a barrel in January of 2020 to as low as $24 per barrel in April 2020. Put succinctly, as of 20th of April 2020, the price of some streams of crude oil fell below $0 per barrel as producers were forced to pay buyers for overwhelmed storage facilities. This fall had adverse implications on the supply of foreign exchange into the country as well as our government revenues. Another event is the deteriorating global financial conditions. Second, the global financial conditions tightened as investors withdrew over $120 billion in portfolio flows from emerging and frontier market countries during the first quarter of 2020. While flows began to recover in the early part of 2021, financial flows to emerging markets like Nigeria are constrained by expected tapering by the US Fed in 2022, which is likely to affect global financial conditions. In essence, uncertainty about the evolution of the virus and the extent of its impact led to a retreat in investment from emerging markets and a corresponding rise in investment in safe haven assets, such as gold and the US Treasury bills. The resulting outflow further heightened pressures on the currencies of major emerging market countries like Nigeria, and this ultimately resulted in the adjustment of our exchange rate. Another event was the spike in food prices. Third, following the provision of vaccines, countries began to ease movement restrictions and demand in certain sectors began to recover to pre-COVID levels. Unfortunately, the surge in demand has contributed to significant supply chain disruptions, which has contributed to elevated inflation in advanced and developing markets. For example, the Food and Agriculture Organization Food Price Index, which measures monthly change in international prices of a basket of food commodities in October 2021, stood at its highest level since July 2011 because of the initially exogenous supply disruptions I'm about to describe. Another event that we are seeing is de-globalisation and supply disruptions. Finally, tragic as these outcomes were, even more alarming was the reaction of many countries at the height of the pandemic. All over the world, countries responded by fighting for themselves. They thought only about their citizens and not the citizens of other countries. Fighting for themselves and taking measures to protect their own people, regardless of the spillover effects on the rest of the world. According to the World Customs Organization, a total of 32 countries and territories adopted stringent and immediate export restrictions on critical medical supplies and drugs that were specifically meant to respond to COVID-19. As of the 4th of April 2020, an updated count of total number of export restrictions by Global Trade Alert Team at the University of Galen, Switzerland, suggests a total of 102 restrictions by 75 countries all over the world. On March 4th, 2020, Germany announced an export ban that applied to all sorts of medical protection gears, including breathing masks, medical gloves, and protective suits. Around the same time, President Macron announced that France will requisition all face masks produced in the country, a de facto export ban. Between 8th of February 2020 and 6th of April 2020, India released 8 different export notifications banning several drugs and medical supplies, including hydroxychloroquine ventilators, oxygen therapy apparatus, and breathing devices. Also, due to fears of global recession, there were worries about unprecedented global food insecurity, with concerns that agricultural production may be dislocated by containment measures that constrain workers from planting, managing, and harvesting critical crops. Consequently, rather than seek cooperative and global solutions, several countries resorted to export restrictions of critical agricultural produce. Indeed, according to the International Food Policy Research Institute, about 37 countries enacted various forms of food export restrictions in response to COVID-19, even in countries where average production exceeds domestic consumption. For example, Vietnam, the world's third largest exporter of rice, suspended granting rice export certificates until the country reviews domestic inventories. Russia, the world's largest wheat exporter, announced a 10-day ban on the export of bulk wheat and rice due to concerns over panic buying in its local supermarkets. Ladies and gentlemen, the dire implications of these events should not be lost on everyone, and indeed on us, Nigerians. A country with over 200 million people, as I've asked in some of my recent treatises on the opportunities of this pandemic. And the questions are, what if the pandemic occurs again and we witness an extended restriction in movements and export bans again? What if these restrictions become a new normal? What if another pandemic occurs in which all borders are closed, with food and medical imports significantly curtailed? What if the rich among us, even when they can afford to pay for their medical bills abroad, cannot travel out of their shores because of these extended lockdowns? Indeed, and I'm sure we know that in Nigeria we lost some very prominent people just because there was a global lockdown that also affected Nigeria. And I ask, are we going to allow our hospitals to remain in their current state without equipment and the state-of-the-art facilities? For how long shall we continue to rely on the world for anything and for everything? That is a question we must answer as Nigerians. Global response. In a bid to contain the spread of the virus as well as to support the recovery of the global economy, there was an unprecedented deployment of fiscal and monetary support measures by countries, even though there was a significant divergence in the force of the response between advanced and developing countries. In 2020, advanced economies on average were able to deploy about 28% of their GDP in fiscal and monetary policy measures, compared with only 6% in emerging markets and less than 2% in low-income countries. For example, the US Fed increased its balance sheet from $4.1 trillion in January 2020 to over $8.6 trillion by October 2021, while the European Central Bank increased its balance sheet from $5.1 to $9.6 trillion over the same period. By the end of 2020, the Fed's balance sheet was 34% of its GDP. The European Central Bank's balance sheet was 59% of its GDP. The Bank of England was 40%. The Bank of Japan, 127%. While measures were deployed by the developing and emerging market economies to support recovery efforts, their response was limited due to constrained fiscal and monetary space relative to their counterparts in the advanced countries. The impact of accommodative fiscal and monetary support, in addition to the deployment of COVID-19 vaccines and the easing of restrictions on movements, helped to support a significant recovery in global growth, which is expected to rise by 5.9% in 2021, up from minus 3.1% in 2020. The recovery of the global economy, however, has been uneven, given the wide divergence in accommodative policy measures and vaccine deployment by advanced economies relative to developing countries. While advanced countries are expected to grow by 5.2% in 2021, growth in sub-Saharan Africa is projected at 3.6% in 2021. In advanced countries like the United States and the UK, over 60% of their population have been fully vaccinated, and efforts are underway in deploying a third dose to their citizens. We also witnessed how some advanced countries impose export restrictions on vaccines until a significant proportion of their population have been vaccinated. However, and unfortunately, in Africa, less than 5% of the total population by October 2021 had been vaccinated. In Nigeria, less than 4 million people out of over 200 million people have been vaccinated. What a shame. Furthermore, the global economy has been affected by rising inflation and supply chain disruptions. The swift recovery in global demand was not followed by a corresponding rise in supply of goods and services, which not only heightened inflationary pressures, but also contributed to significant supply disruptions. Average intercontinental freight rates for a 40-foot container rose from $1,500 in January 2020 to over $10,000 by September 2021. Naturally, this will result in increase in prices. The rise in freight rate, along with demand pressures, also helped to support a significant rise in food prices. Reflecting this pressure, FAO Food Price Index stood at its highest level in October 2021 since July 2011. Inflationary pressures in advanced and developing countries have been aggravated by rising commodity prices such as crude oil, which would likely reshape the accommodative monetary policy stance of major central banks in 2022. What has been the impact on the Nigerian economy? In Nigeria, the impact of these external factors as a result of COVID-19 pandemic have also worked to shape developments in our economy over the past year. Given our reliance on revenues from the export of commodities such as crude oil, the fall in crude oil prices from a high of $68 a barrel in January 2020 to $24 per barrel in April 2020 had adverse implications on the supply of foreign exchange into the country, as well as on government revenues. While oil prices have risen to close to $80 today, OPEC restrictions on our production output, along with the rising cost of petroleum imports, have prevented us from being able to harness the gains from this unexpected rise in price of crude oil. On exchange rate, as a result of the drop in exchange supply arising from low earnings from the sale of crude oil, our naira depreciated by 7.7% from 380 naira to the dollar to 410 at the INE window. Supply was also affected by massive outflow of foreign portfolio investments from emerging and frontier markets, including Nigeria, in 2020. A combination of these factors led to a marked drop in our foreign reserve from nearly 36.7 billion at the beginning of the crisis in March 2020 to a low of 32.9 in June 2021. It is important to state that the volume of activities at the investors and exporters window fell from nearly $250 to $300 million daily during the high points pre-COVID to less than $40 million daily during the first quarter of 2021. Third, the imposition of containment measures as well as the rising cost of imported goods due to supply destruction helped to aggravate inflationary pressures during the second half of 2020. Our inflation rate rose from 12.12% in January 2020 to 18.17% in March 2021. Part of the rise in inflation was due to the surge in demand that arose from the easing of restrictions on movements, which led to a growing disparity between demand orders and output from factories and farms, not only in Nigeria, but in other parts of the world. Heightened demand, along with the adjustments in our exchange rate, farmer-herder clashes, imported inflation, insecurity in parts of the Food Belt region, and rising transportation costs were some of the key factors that drove the increase in inflation rate in Nigeria. Consequently, the pandemic and its attendant effects reordered the paths of our key macroeconomic and financial indicators after the gains we had achieved following the impact of the 2015 to 2017 oil price crisis. As a result of these effects, the Nigerian economy fell into a second recession in 4 years during the third quarter of 2020. However, the banking sector remained robust and sound due to prompt response by the central bank in order to prevent an economic crisis from spilling over into a financial crisis. As a result, the banking sector continued to consolidate on its gains of the recovery from 2016 and 17 recession. Although we saw some fragilities in the system, they constituted limited risks. Prudential indicators such as the non-performing loans ratio stood at 5.4% in November 2021, while capital adequacy ratio in the banking industry remained above 15%, indicating continued resilience of our banking system. What were the response from the monetary authorities? The impact of the COVID-19 pandemic provided many lessons that has helped to shape subsequent actions by our monetary policy authorities. For example, we realized how vulnerable our economy was relative to advanced markets in not only access to essential medical supplies, but in the form of monetary policy support that central banks in developing countries could provide in supporting the recovery of their respective economies. Rather than let the crisis compound our problems, we reflected on ways in which we could turn the crisis into an opportunity. One that will reset the trajectory of our economy from its dependence on imported items to one that is more resilient and productive. And that is the journey that we are determined today that we must continue. That we must diversify our economy. That we must as Nigerians, fold our sleeves and do this by ourselves and not rely on others. With the pace at which the viruses are spreading, which could significantly derail economic growth, we were further emboldened to work on measures that would improve productivity, support employment generation, and strengthen the resilience of our economy. As a result, working with our fiscal authorities, we took unprecedented measures to contain the effects of the pandemic on our economy, in addition to other efforts aimed at stimulating greater economic activity in key sectors of our country, of our economy. What were some of the measures that we took to contain the COVID-19? First, the central bank, working with fiscal authorities in stimulating strong policy support measures capped under the Economic Sustainability Plan, which was designed to contain the effects of the pandemic, restore stability to the economy by helping households and businesses affected by the pandemic, and to lift our economy out of the woods through massive interventions to critical sectors. Under this plan, the CBN and the fiscal authorities collectively mobilized and injected over 5 trillion naira to support households and businesses. It is gratifying to state that the Central Bank of Nigeria deployed more than 3.5 trillion naira, about 4.1% of Nigeria's GDP, to critical sectors such as agriculture, manufacturing, electricity, and healthcare in order to stimulate and help the economy recover from the deep shock. Other specific policy measures undertaken include: A, reduction in monetary policy rate from 13.5 to 11% to improve the flow of credit to households and businesses. B, reduction of interest rate on CBN interventions loans from 9 to 5%. C, extension of the moratorium on principal repayments for CBN intervention facilities to March 2022. D, we granted regulatory forbearance that allowed banks restructure loans given to sectors severely impacted by the pandemic. E, we strengthened the loan-to-deposit ratio policy, which has resulted in a significant rise in loans provided by financial institutions. For instance, Sector Coalition COVID team, we raised 39.646 billion to support the fight against the scourge. The funds were used to support 3 key priority areas: development of 39 fully equipped isolation centers, including ICUs and molecular testing labs, and procurement of medical equipment such as PCR test kits across the country. The CBN also created a 1 trillion naira facility in loans to boost local manufacturing and production across critical sectors of our country. We created a 100 billion naira intervention fund for the pharmaceutical companies and health practitioners to expand and strengthen the capacity of healthcare institutions. So far, over 107.7 billion has been released to support 111 healthcare projects, including 6 greenfields and 108 expansionary brownfields. The journey so far and our scorecard. As a result of these measures, we witnessed robust economic recovery as GDP growth stood at 4.03% during the third quarter of 2021, following the 5.01% growth recorded during the second quarter of 2021. The economy has remained on a positive growth path for 4 consecutive quarters after the recession during the third quarter of 2020. 41 out of 46 sectors assessed during the third quarter by NBS recorded positive growth, as growth was driven by significant improvements in our non-oil sector. Our interventions, particularly in the manufacturing and the agricultural sector, significantly helped to encourage continuous improvement in growth in these 2 key sectors of our economy. Today, our food production systems have become more sustainable due to the improved output at our farms and local factories. Output of staple commodities such as rice, maize, palm oil, and tomatoes have grown significantly, and we have also seen increased efforts of our local manufacturing firms to engage in backward integration efforts. On inflation, inflation has continued to moderate for 7 consecutive months as it declined from 18.17% in March 2021 to 15.9% in October 2021. On reserves, supported by our demand management policy, in addition to support from successful issuance of the €4 billion bond and IMF SDR, Our reserves today stand at over $41 billion, which is enough to support over 9 months of imports. This is not just a moral booster for both foreign direct and portfolio investors willing to invest in the economy, but it provides significant firepower to support our domestic industries that need to import critical machines. On exchange rate, as a result of our demand management again, the Naira has remained largely stable at 411, sometimes moving to up to about 415 at the INA window since the discontinuation of FX allocation to broad exchange operators, along with the convergence between the CBN and FX rates. Our current account deficit has narrowed significantly from a huge deficit of 4.53% of GDP in the fourth quarter of 2020 to minus 0.44% of GDP during the second quarter of 2021 due to a surplus position in the goods account. What's our outlook? Following the impact of the various accommodative policy measures, our economy made a swift exit from the recession. Unlike the 5 quarters it took to exit the previous recession, the economy rebounded after just 2 quarters of contractions, underpinning the resilience of the economy amidst greater policy support. I'm delighted to note that growth has returned to pre-COVID levels due to the accommodative policy support provided by the CBN and our government. Our focus for 2022. I'd like to state that notwithstanding these positive indicators, our economic growth remains fragile, as our unemployment and inflation rate remains at levels that are not very supportive of growth. Second, continued implementation of our intervention efforts would need to be undertaken to sustain the recovery efforts and stimulate further growth of the economy. Third, given the population growth rate of about 2.7% annually, it is important that we continue to deploy measures that will enable our economy to attain annual growth rate of above 5%. Through the pandemic, we are aware that our policy responses are often more effective when we work with the private sector. For example, the COVID Alliance played an instrumental role in reducing the negative effects of the pandemic by providing palliative support to families affected by the virus. As a result, all efforts in 2022, we dare say, must be geared to ensure that we maintain our focus on improving access to finance and credit for households and businesses, mobilizing investment to boost domestic productivity, enabling faster growth of non-oil exports, and supporting employment generating activities. Our 100 by 100 production project. In an effort to implement policies that would engender growth and employment, the CBN recently unveiled the 100 for 100 policy on production and productivity. Under this program, targeted credit of up to 5 billion naira will be provided to 100 firms every 100 days, provided that these firms are investing in projects that are greenfield projects. Second, projects will be assessed on their ability to generate significant employment opportunities in critical sectors of our economy. Third, eligible firms must show evidence of their efforts to harness available local raw materials towards the realization of their intended investments. Efforts will also be made to support firms that are geared towards producing goods for the export market. The CBN is committed to supporting eligible firms with foreign exchange to import machineries and equipment. And let me add that routine audits will be conducted on firms that receive funding to ensure that they are complying with the terms of the program. We will also, during this period, be supporting the growth of our digital economy. A key focus of the CBN under our leadership has been the enabling of build-out of robust payment system infrastructure in Nigeria that will provide cheap, efficient, and faster means of conducting payments for most Nigerians. With the growing pace of digitalization globally, it is essential that we leverage digital channels in fulfilling this objective. Total transactions volumes using digital channels more than doubled between 2018 and 2020, as volumes rose from 1.3 billion to over 3.3 billion financial transactions in 2020. Now, notwithstanding these gains, close to 36% of adult Nigerians do not access our financial services in Nigeria. So we will also be doing everything possible using digital channels to deepen financial inclusion during this period. On e-Naira, it is in this vein that the CBN recently deployed the first central bank digital currency in Africa. The e-Naira, which would help in attaining our goals of fostering growth greater inclusion using digital channels, supporting cross-border payments for businesses and firms, and providing a reliable channel for remittance inflows into Nigeria. The e-Naira will ensure that Nigerians in remote areas can conduct financial services using their digital device at little or no cost. On infrastructure, with the decline in revenues due to federal and state governments as a result of reduced receipts from the sale of crude oil, alternative ways of funding infrastructure are critical if we are to ensure sustained growth of our economy. As we are all aware, the cost of logistics is often seen as a significant impediment to the growth of businesses in the country. In recognition of the role improved infrastructure could play in the development of our economy, along with the need to leverage private sector capital in funding over 35 trillion naira deficit, which is the estimated amount required to build an efficient infrastructure system in Nigeria, the CBN, working in partnership with critical stakeholders such as the Nigerian Sovereign Investment Authority and the AFC, set up the InfraCorp. InfraCorp is expected to raise over 15 trillion in its first phase to support investment in critical infrastructure in Nigeria. Let me say that we are happy that all the logistics, all the approvals that are needed for the effective takeoff of InfraCorp has already been obtained, and the InfraCorp is already evaluating 3 projects in Nigeria that will cost almost close to about 1.5 trillion naira, which will be our first set of assets that will be handed over to the Infrastructure Corporation. Now, we also do intend to mobilize international capital. A key challenge to supporting the growth in key sectors of our economy is access to large pools of cheap investment capital. Today, over $100 trillion is held by institutional investors in OECD countries, most of it invested in low-yielding assets relative to high-yielding opportunities in Nigeria. And working to tap into this pool of funds will require the setup of an investment framework that offers comfort and security to investors seeking to invest in critical sectors of our economy. As a result, the CBN is working to set up the International Financial Center at a core Atlantic city in Lagos that will serve as a hub for attracting domestic and external capital, which is needed to strengthen our post-COVID economy. Our International Financial Center, when fully operational in the second quarter of 2022, will help to position Nigeria as a key destination for investment in Africa. So in concluding, let me say Let me add that while we have been able to contain some of the effects of COVID-19 pandemic, our economy it is imperative that we work to build a more resilient economy that is better able to contain external shocks whilst supporting growth and wealth creation in key sectors of our economy. We must take deliberate steps to diversify the base of the Nigerian economy. As the true African giant, we must fold our sleeves and do everything possible to stop the incidence of importing anything and everything. I believe that what happened, the lessons from COVID-19, the lessons from the lockdown that we witnessed in 2020 are enough for us to know that as a country with a population of over 200 million people, that it is time for us to do these things ourselves. It is time for us to deploy all resources that we have to help diversify the base of our economy. I am optimistic that this can be done because Nigeria possesses both the human and material talents that can do this. Nigerians in any part of the world have always stood tall in all that they do. And I believe that we, working together as Nigerians, should be able to bring our country to the level that it truly deserves as the giant of Africa. So I want to thank all of you for being here today, but I think the message remains that we all need to work together for the growth of our economy and be less reliant on others. I thank you all.